Sir, please start.
Okay, thank you. Good afternoon, students, and I welcome back to you the accounts that we have already started. Now I'm coming to classification of accounts, which are called modern classification of account. In modern classification of accounts, we are having assets account, then liabilities account, then capital account, then revenue account, then expense accounts and withdrawal account. So that is the modern classification of accounts. Now, so far books of accounts are concerned, we are having journal and then we are having ledger. And accordingly, we are having cash book, purchases day book, where all the credit purchases are recorded, sales day book, where all credit sales are recorded, return inwards book, return outwards book, and journal proper. And apart from that, in ledger, we are having general ledger, debtors ledger, and creditors ledger. General ledger means which records all nominal accounts. Debtors ledger, it is related to debtors account, and creditors account is related to creditors. So debtors ledger are related to credit sales, and creditors ledger, they are related to credit purchases. Now we are coming to recording of transactions. In firstly, we are having cash transactions which are recorded in the cash book, then purchases book, purchases return, return outward book, sales return, return inwards book, and journal proper. Now we'll come to journal proper later. Now first, let us consider cash book, and depending upon the kinds of cash book, there is a simple cash book or single column cash book. This book has cash column only, then two column cash book or double column cash book. This book has both cash and discount columns. Then three columnar cash book or triple column cash book. This book has cash, bank, and discount columns. And apart from that, there is another cash book which records petty small transactions which are recorded in a cash book, that is called petty cash book. So these are the format of single column cash book. Then we are having two column cash book. Then we are having three column or triple column cash book, where we are having discount allowed, cash column, and bank column. Similarly, discount receipt, cash column, and bank column. Now we are coming to next important concept, that is trade discount. Now what is trade discount? It is an allowance given by the wholesaler to the retailer. Now trade discount is a reduction from the catalog price. Catalog price means where the price of the goods are actually being mentioned in a catalog, and when the wholesaler of the goods selling the goods to the retailer, then the wholesaler is actually allowing certain discount to the retailer on the catalog price. Okay, the retailer makes profit by selling the goods at catalog price, but the rate percentage of discount differs from business to business, commodity to commodity. Trade discount is shown by way of deduction in invoice. Therefore, no separate entries are required in the cash book. Remember, trade discount is never recorded in the books of accounts. So catalog price minus trade discount, the net price is actually being recorded. Hence, there is no question of any recording of trade discount in the books of accounts. Now we are coming to cash discount. It is an allowance given by the receiver of cash to the payer for prompt payment within the stipulated time period as per credit terms of a receiver. When goods are sold on credit, the customer is expected to make payments before the due date. In order to encourage the customer to make the payment before the due date, cash discount is given. Now, in short, if I discuss about what is the meaning of cash discount, then the answer is very simple. Cash discount is a discount which is actually being allowed by the business to the customers who generally make some prompt payments. Usually what happens when the goods are actually being sold on credit, then we pass the entry customer account debit to sales, and there is a payment term or fixed number of period, maybe 1 month, maybe 15 days, maybe 1 month, maybe 2 months. This credit period is actually being allowed by the business to the customers. Now, when customers are making payment before the due date, say payment is due say after 1 month, but customer is making payment say on the 10th of the month, and then business is actually allowing certain amount of discount for the prompt payment of the customers, then it is actually being termed as cash discount. The discount encourages the customers to take advantage of the benefit that is availing of the discount facility, and in the cash book, discount received and discount paid are recorded in the discount columns accordingly, and then the total discount are posted to the ledger. So in cash book, there is a discount allowed column, and in the cash book in the credit side, there is a discount received column. Discount that will be allowed by the suppliers to the business for prompt payment by the business, then it will be recorded as cash discount received. Now we are coming to contra entries. Now, when in a transaction, both cash and bank are involved, that is cash deposited into the bank or cash drawn from the bank, either of the cash or bank account are debited and credited simultaneously. That is when amount is actually being paid to the bank, then bank will be debited and cash will be credited. And again, when the money is withdrawn from the bank, then cash account will be debited and bank account will be credited. Remember, cash book is called journalized ledger. Since the cash book is both the journal and also the ledger, there is no separate place to record the cash and the bank transaction, and so such entries are marked with this contra sign in the ledger folio. Ledger folio number, column of both debit and the credit side of the cash and bank transactions entered. So those entries are called as contra entries. Now, I have already told you there is a purchase journal book where all the credit purchases are actually being recorded. Then purchase return journal book, that is when returns are actually being made so for the purchases are concerned, then it is recorded in the purchase return. Then there is a concept called debit note. Okay. So that debit note is nothing but a debit note is a document evidencing a debit to be raised against a party for reasons other than sale on credit. On finding that goods supplied are not as per the terms of the order placed, the defective goods are returned to the supplier of the goods and a note is prepared to debit the supplier, or when an additional sum is recoverable from a customer, such note is prepared to debit the customer with the additional dues. So in these two situations, the note which is actually being issued, that is called debit note. So this is the format of the debit note, name of the firm issuing the debit note, address of the firm, date of issue, then again supplier's name, goods returned as per delivery, challan number, details of goods written, rupees, and signature. Similarly, a credit note is prepared when a party is to be given a credit for reasons other than credit purchase. So it is a common practice to make it in red ink. When goods are received back from a customer, a credit note should be sent to him. The suggested pro forma of credit note that is actually being seen over here. That is name of the firm issuing the note, address of the firm, date of issue, against customer's name, goods returned by the customer, challan number, details of goods returned, rupees involved, and signature. Then there is a concept of sales journal. When the goods are actually being sold on credit, the format of sales journal is this, that is date, invoice, name of the customer, account to be debited, ledger folio, and amount rupees. Then sales return. The customers who are actually returning the goods are actually being recorded over here. That is date, credit number, name of the customer, amount to be credited, ledger folio, and amount rupees. Now we are coming to journal proper. Now, a book maintained to record transactions which do not find place in special journal is known as journal proper or journal residual. Following transactions are recorded in this journal. Number one, opening entry. So in order to open new set of books in the beginning of new accounting year and record therein opening balances of assets, liabilities, and capital, the opening entry is made in the journal. Then adjustment entries. In order to update ledger account on accrual basis, such as entries are made at the end of the accounting period, such as for rent outstanding, prepaid insurance, depreciation, and commission received in advance. Then rectification entries to rectify errors in recording transactions in the books of original entry and their posting to ledger account. This journal is used. Number 4, transfer entries. That is, drawing account is transferred to capital account at the end of the accounting year. Expenses accounts and revenue accounts which are not balanced at the time of balancing are open to record specific transactions. Accounts relating to operation of business such as sales, purchases, opening stock, income, gains and expenses, etc. and drawing are closed at the end of the year and their total or balances are transferred to trading and profit and loss account by recording the journal entries. These are also called closing entries. So transfer entries are also called closing entries. Next, we are having other entries in addition to point number 1 to 4 that I have discussed. That is, in addition to the above mentioned entries in the points number 1 to 4, recording of the following transactions is done in the journal proper. Number 1, at the time of a dishonor of a check, the entry for cancellation for discount received or discount allowed earlier. Then purchase or sale of items on credit other than goods. Goods withdrawn by the owner for personal use. Goods distributed as samples for sales promotion. Then endorsement and dishonor of bill of exchange. Endorsement means giving to third party and dishonor of bills of exchange. Transactions in respect of consignment and joint venture, etc. Then loss of goods by fire, theft, spoilage, etc. Now petty cash, I have already told you, a book used to record small cash payments. Now we are coming to one of the most important topic, that is bank reconciliation statement. Now, as the name suggests, bank reconciliation statement. So that's why it is a statement but not an account. Reconciliation means making or sorting out the differences between bank balance as per cash book and also bank balance as per passbook. And this bank reconciliation statement is actually being prepared by the organization, keeping into account the bank statement, that is the passbook which is actually being issued by the banker. So the amount of balance shown in the passbook or the bank statement must tally with the balance as shown in the cash book. But in practice, these are usually found to be different. Hence, we have to ascertain the causes of such difference. So on a particular date, the bank balance as is shown by the cash book may differ from the passbook. Okay, hence we have to ascertain the causes of such difference. Now it will be observed that a bank statement, because in organizations, business organizations, the number of transactions are huge, many transactions. Hence, banker will be issuing a bank statement. That is also known as passbook, shows all deposits in the credit column and withdrawals in the debit column. Thus, if deposits exceed withdrawals, it shows a credit balance, and if withdrawal exceed deposits, it will show a debit balance. That is called overdraft. Now, the next question that is coming in our mind, why there is a need for reconciliation? It is generally experienced that when a comparison is made between the bank balance as shown in the firm's cash book, the two balances do not tally. Hence, we have to first ascertain the causes of difference thereof, and then reflect them in a statement which is called bank reconciliation statement. To reconcile means to tally the two balances. So, in short, if there is a disagreement of balance between bank balance as per cash book and that of bank statement or passbook, there is a need for reconciliation. Now, in order to prepare a bank reconciliation statement, we need to have a bank balance as per the cash book and a bank statement as on a particular day, along with details of both the books. If the two balances differ, the entries in both the books are compared and the items on account of which the difference has arisen are ascertained with the respective amounts involved so that the bank reconciliation statement may be prepared. Now, this is the format. Say if we start with balance as per cash book, and then if there are certain adjustments which are actually not taken in cash book but in bank statement, namely checks issued but not presented, interest credited by the bank but not recorded in the cash book, these are added, and checks deposited but not credited by the bank, bank charges not recorded in the cash book, these are deducted. These are the examples I'm giving. And ultimately, balance as per the passbook, we generally derive. Now, it can also be prepared with two amount columns, one showing additions, that is plus column, and another showing deductions, that is minus column. For convenience, we may use or adopt this statement, namely bank balance as per cash book, checks issued but not presented, interest credited by the bank. Okay, these are added and shown in the amount rupees plus, checks deposited but not credited by the bank, bank charges not recorded in the cash book. Then finally we are in a position to arrive at balance as per the passbook. Now, preparation of bank reconciliation statement. After identifying the causes of difference, the reconciliation may be done in the following two ways. Preparation of bank reconciliation statement without adjusting cash book balance. And number two, preparation of bank reconciliation statement after adjusting cash book balance. Now we are discussing preparation of bank reconciliation statement without adjusting cash book balance. Just a minute. Now, to prepare bank reconciliation statement under this approach, the balance as per cash book or as per the passbook is the starting item. The debit balance as per the cash book means the balance of deposits held at the bank. Such a balance will be a credit balance as per the passbook. For your convenience, please remember that passbook is the opposite of cash book. In cash book, debit denotes deposits, credit denotes withdrawals, whereas passbook debit denotes withdrawal and credit denotes deposit. Such a balance exists when the deposits made by the firm are more than his withdrawals. It indicates the favorable balance as per cash book or favorable balance as per the passbook. On the other hand, the credit balance as per the cash book indicates bank overdraft. In other words, the excess amount withdrawn over the amount deposited in the bank. It is also known as unfavorable balance as per cash book or unfavorable balance as per passbook. Now, we may have 4 different situations while preparing the bank reconciliation statement. What are those? Number 1, when debit balance, favorable balance as per cash book is given and the balance as per passbook is to be ascertained. So starting with favorable balance as per cash book and ending with or determination of ascertainment of bank balance as per passbook. Number 2, when credit balance, favorable balance as per passbook is given and the balance as per cash book is to be ascertained. Third situation, when credit balance as per cash book, unfavorable balance, overdraft balance is given and the balance as per passbook is to be ascertained. And the fourth one, when debit balance as per passbook, unfavorable balance, oblique overdraft balance is given and the cash book balance as per is to ascertain. So these are the situations. Now we are taking one problem. Following the following particulars or from the following particulars, prepare the bank reconciliation statement of Sri Kishan as on 31st March 2023. So we are provided with the bank balance as per passbook. Since nothing has been mentioned, we understand that it is a credit balance as per passbook that is favorable 10,000. Now bank collected a check of rupees 500 on behalf of Sri Kishan but wrongly credited it to Sri Kishan's account. So check wrongly credited to another customer account. So bank balance as per passbook is to be increased. That's why 500 is to be added. Next, bank recorded a cash book deposit of 1589 as rupees 1598. So error in error in, that is the difference actually 1598 minus 1598 minus, just a minute, 1589, so it comes to 9 rupees. So that 9 rupees excess credit for cash deposit, that is shown in the minus column. Then withdrawal column of the passbook undercast by rupees 100. So withdrawal means credit side. So undercasting of withdrawal column, then in the minus it will be 100. Again, the credit balance of rupees 1500 as on the passbook was recorded in the debit balance. So there will be a double effect, that is error in carrying forward, that is 1500 plus 1500, that is 3000. The payment of a check of rupees 350 was recorded twice in the passbook. So definitely check recorded twice, it will be shown in plus column, that is bank balance as per passbook will be more. The credit balance of rupees 1500 as on the passbook was recorded in the debit balance. Okay, so the payment of a check of rupees 350 was recorded twice in the bank. So check recorded twice, it will be shown in the plus column. Then the passbook showed a credit balance for a check of rupees 100 deposited by C. Kishan. So under casting of withdrawal column, so passbook balance will be reduced. It will be shown. Then in this way, we can arrive at the balance. Now, when there are numerous errors, okay, so when we look at the various items that normally cause the difference between the passbook balance and the cashbook balance, we find a number of items which appear only in the passbook. Then why not first record such items in the cashbook to work out the adjusted balance, also known as amended balance of the cashbook, and then prepare the bank reconciliation statement. The idea is, if there are certain errors in the cashbook, then first we are required to correct the cashbook by adjusting the cashbook and to find out the adjusted balance, also known as amended balance, that is cashbook amended method, and then we go for the preparation of the bank reconciliation statement. This shall reduce the number of items responsible for the difference and have the correct figure of balance at bank in the balance sheet. In fact, this is exactly what is done in practice, whereby only those items which cause the difference on account of the time gap in recording appear in bank reconciliation statement. These are as checks issued but not yet presented, checks deposited but not yet collected, number 3, due to an error in the passbook, etc. Now we are coming to just take the bank reconciliation statement after amendment, how it is prepared. The stepwise preparation of bank reconciliation statement we are discussing. Say the following is the summary of a cash book for December 2022. Opening balance BD, that is 6849. Then payments, then receipts, then closing balance. Remember, all we are discussing with reference to cash book bank column. So you are having a credit balance of 6849. Then there are certain payments. Then there are certain receipts, and closing balance of the cash book bank column is given as balance CD, that is 4986. All receipts are banked and payments are made by checks. On investigation, the following are observed. Bank charges of rupees 1224 entered in the bank statement have not been entered in the cash book. So, in amended cash book, we are going to make the correction and try to find out the correct balance. Checks drawn amounting to rupees 2403 have not been presented to the bank for payment. So it is recorded in the cash book. No adjustment is required in the cash book, but it will come in the bank reconciliation. Checks received totaling rupees 6858 have been entered in the cash book and deposited in the bank, but have not been credited by the bank until January 2023. So this is also not recorded in the passbook. Hence, we are not required to make any adjustment in the cash book. So for the amended cash book is concerned, rather it will come in the bank reconciliation statement. A check of rupees 198 has been entered as receipt in the cash book instead as a payment. So we have to adjust the cash book a check for rupees 225 has been debited by the bank in error. So it is a mistake. So for the bank statement is concerned, and remember, bank statement is prepared by the bank. Trader has no right to write anything in the bank statement. A check received for rupees 720 has been returned by the bank and marked no funds available. No adjustment has been made in the cash book. So it is also to be recorded in the cash book. All dividends receivable are credited directly to the bank during December. An amount of rupees 558 was credited by the bank and no entry is made in the cash book. So you have to correct the cash book. A check drawn for rupees 54 has been incorrectly entered in the cash book as 594. So cash book is to be adjusted. The balance brought forward should have been 639. The bank statement as on 31st December showed an overdraft of rupees 10458. Now the question is, you are required to prepare an amended cash book and prepare a bank reconciliation statement as on 31st December 2022. Remember, bank reconciliation statement should be prepared taking into consideration a particular date, that is December 31st, 2022, as the question suggests, because within that date, what are the corrections which are required to be made in the cash book and what are the transactions which are not recorded in the past book but recorded in the cash book, that we want to justify. So first we are going to prepare an amended cash book bank column. So we have to take opening balance, then bank charges not recorded, we record it. Then adjustment regarding check entered as received, that is 396. Adjustment regarding check return 720. Then in the debit side, dividend received, adjustment for check drawn for rupees 54 entered as rupees 594, that is 540 is to be added. Adjustment of balance brought forward, and then we get two balance CD 5778, and that balance is brought forward. So cash book amended means corrections have been made, and remember, these items will not be touched in the bank reconciliation statement anymore. So when we are going to adjust the cash book, that is when you are going to amend the cash book and bringing the corrected balance with this balance, that is 5778, we have to prepare the bank reconciliation, and only the transactions or the items which are not recorded in the past book, that will be taken care of. So let us start with the bank reconciliation. Overdraft as per bank statement 10,458. Then add check issued but not yet presented for payment. Okay, that is to be added. So it is not recorded in the past book but already been recorded in the cash book. So that's why these items will only come in the bank reconciliation, that is check issued but not yet presented for payment 2403, then less checks deposited but not yet credited. That is the mistake in the bank statement. That's why we have taken minus 6858. Check debited in error 225. Then balance as per cash book will be 577. Now that is your bank reconciliation statement. Now I'm just looking if you have any question on this bank reconciliation statement. Okay, no question. So next we are coming to trial balance, and then we'll be discussing rectification of errors. Now, meaning of trial balance. So first we have to know what is called a trial balance and why it is prepared, and what are the various purposes that are served by the trial balance. Now we are coming to meaning of trial balance. A trial balance is a statement showing the balances or total of debits and credits of all the accounts in the ledger with a view to verify the arithmetical accuracy of posting into the ledger accounts. Remember, mind this word, arithmetical accuracy of posting into the ledger. So by preparing trial balance, we want to justify whether total debit is equal to total credit. So far arithmetical accuracy of posting into the ledger accounts are concerned. So trial balance is an important statement in the accounting process which shows the financial position of all accounts and helps in preparing the financial statements, that is trading profit and loss and balance sheet. The task of preparing the statements is simplified because the accountant can take the account balances from the trial balance instead of looking up in the ledger. So this is the format, that is account, title, ledger folio, debit amount rupees, credit amount rupees. It is normally prepared at the end of an accounting year. However, an organization may prepare a trial balance at the end of any chosen period, which may be monthly, quarterly, half-yearly, or annually, depending upon its requirements. Now, in order to prepare a trial balance, there are certain specific steps which are taken into account. Number one, firstly to ascertain the balances of each account in the ledger. Then to list each account and place its balance in the debit or credit column as the case may be. If an account has a zero balance, it may be included in the trial balance with zero in the column for its normal balance. Then to compute the total of debit balances column. Then to compute the total of the credit balances column. Then to verify that the sum of the debit balances equals the sum of credit balances. If they do not tally, it indicates that there are some errors. So one must check the correctness of the balances of all accounts. Now you have to note that is, it may be noted that all assets, expenses and receivables account shall have debit balances, whereas all liabilities, revenues and payables accounts shall have credit balances. Now, just I have given an example. Capital having credit balance, liability, land and buildings, debit balance, plant and machinery, fixed assets, land and building is also a fixed assets, debit balance, equipment having debit balance, asset, furniture and fixtures, also assets, debit balance, cash in hand, cash at bank, both having assets, debit balance, debtors, debit balance, bills receivable, debit balance, stock of materials, work in progress, stock of finished goods, all are assets, prepaid insurance, purchases, carriage inwards and carriage outwards, having debit balances, sales credit, sales return debit, purchase return credit. Okay, purchase having a debit balance, interest paid debit, commission discount received credit, salaries debit, long-term loan liability credit, bills payable liability credit, creditors liability credit, outstanding salaries liabilities credit, outstanding interest earned. It is an asset debit. Advances from customer, it is a liability credit. Drawings debit, reserve fund, it's credit. Provision for doubtful debts, that is also credit. Now, what I have said, this particular trial balance, which shows the arithmetical accuracy, that is total debit is equal to total credit or not. But there are certain errors which cannot be detected by the trial balance. And for that reason, we are going to discuss what are the various errors which are not to be detected by the trial balance. And for that purposes, what type of rectification entries we are going to pass. Now, errors we can post into two heads. One is number one, errors of omission, and number two, errors of commission. Now, under errors of omission, we are having complete error and we are having partial error. Under errors of commission, we are having errors of principle, we are having compensating errors, errors of posting, and errors of casting. Now, we are discussing that is classification of errors. Keeping in view the nature of errors, all the errors can be classified into the four categories. Errors of commission, errors of omission, errors of principle, and compensating errors. Errors of commission means you have recorded a particular account in the wrong account or wrong side. Errors of omission means which you have totally omitted for recording a particular item. Errors of principle means these errors are related to accounting principles. Supposing if you purchase any asset for business purpose, then asset account is debited and supplier account is credited. Supplier for machinery, say. Now, instead of debiting the plant and machinery that we have purchased, you have debited purchase account. Okay, that is called error of principle. Say you have purchased goods, then purchase account debit to cash or bank, or purchase account debit to creditors. That is the correct entry. When you have sold the goods on cash, that is cash account debit to sales or customer's account debit to sales. Now, when you are purchasing an asset, then that asset account is nothing but is a real account. Debit what comes in should be debited. Instead of that, instead of debiting the asset account, you are actually debited the purchase. Then it is called error of principle. Compensating error means supposing you have shown 50 rupees as 500 you have received as 500. Say you have received for 50, but you have shown as 500. Then you have paid 50, you have shown 500. So these are called compensating errors. Then there is a concept called suspense account. What is that? Even if the trial balance does not tally due to the existence of one-sided errors, accountant has to carry forward his accounting process, prepare financial statements. The accountant tallies his trial balance by putting the difference on shorter side as suspense account. Say your debit is, say for example 4,000. your credit is 3,800, then you are going to put suspense account in the credit side, sorry, in the credit column of the trial balance, so that total debit is equal to total credit. Okay, so basically one-sided errors which are actually to be corrected by putting it into a suspense account. Now, it may so happen that you have not detected the errors in the financial year. Say errors have been actually being taken place in the year, say 2023-24, but you have actually got the errors and rectified the errors only after the next accounting year. Then what is to be done, that I am discussing. If some errors committed during an accounting year are not located and rectified before the finalization of financial statements, suspense account cannot be closed and its balance will be carried forward to the next accounting period. So when the errors committed in one accounting year are located and rectified in the next accounting year, profit and loss adjustment account is debited or credited in place of accounts of expenses and losses and incomes and gains, in order to avoid impact on the income statement of next accounting period. Okay. Now, when errors are detected after preparation of final accounts, the following points should be kept in mind. All the nominal accounts have been closed after transferring to trading account or profit and loss account. The suspense account, if any, has been carried forward to the next period. It should appear in the balance sheet under current assets if it has a debit balance, and current liabilities if it has a credit balance. Real and personal accounts also have been carried forward to the next period. Now, we are just considering one question to make you understand. Just have a good look. The books of accounts of A Company Limited for the year ending 31st December were closed with a difference in books carried forward. The following errors were detected in the next year. Number one, returns outward book was undercast by rupees 150. Then rupees 1,500 being the total of the discount column on the credit side of the cash book was not posted in general ledger, that is nominal ledger. Rupees 6,000 being the cost of purchase of office furniture was entered in the purchase account. Then a credit sale of rupees 760 was wrongly posted as 670 to the customer's account in the sales ledger. Then closing stock was overstated by rupees 9,000, being casting error in the schedule of inventory. Pass rectification entries, prepare suspense account, and find out the effect of corrections on 31st December profit. So we are taking one by one. Returns outward book was undercast by rupees 150. So what is the meaning of return outward? That is return outward. That means you have purchased the goods and you are returning the goods. It was actually undercast. That is 150 rupees has been shown less. So that's why your profit was less. So you have to adjust with a suspense account. Suspense account debit to profit and loss adjustment account. That is 150 and 150. Narration being return outward book undercast by rupees 150, now rectified. Remember, accounts is already been closed. Profit you have derived. Hence, any return outward is a nominal account. Okay, that is any adjustments for the nominal accounts are to be passed through profit and loss adjustment account. Here profit will be more because return outward is the reduction from purchases, but it is an one-sided error. That's why you have written suspense account debit 150 to profit and loss adjustment account 150. Next, rupees 1,500 being the total of the discount column on the credit side of the cash book was not posted in general ledger. So 1,500 in the total of the discount column on the credit side of the cash book. Remember, I have already told you at the time of discussion, discount allowed is debited, discount received is credited, is a nominal account. Hence, what we have done, that is 1,500 being the total of the discount column, that is discount received, was not posted. So that's why your profit was less. We have to increase our profit. Hence, suspense account is to be debited because it is an one-sided error to profit and loss adjustment account 1,500, 1,500 being discount received not posted from cash book to ledger, now recorded. Next, rupees 6,000 being the cost of furniture of office furniture was entered in the purchase account. Remember, it was a error of principle because when any asset is purchased, office furniture is an asset. Hence, you have to debit office furniture, but wrongly you have debited purchase account. So, in this way, you have reduced your profit. Hence, what you are required to do, you have to increase your profit, and office furniture you have not debited, that is to be recorded. So that's why office furniture account debit will be 6,000 and profit and loss adjustment account will be 6,000. Remember, we are adjusting through profit and loss adjustment because account is closed and rectifications are actually being made at the beginning of the next year. So the entry will be office furniture account debit 6,000 to profit and loss adjustment account. Being purchase of office furniture wrongly entered in the purchase account, now rectified. Now, next one is a credit sale of rupees 760 was wrongly posted as 670 to the customer's account in the sales ledger. So it is related to customer's account, okay, and it is related to one-sided error with rupees 90 because 760 and 670, the difference is 90. Hence, your customer account will be increased by 90. So we write customer account debit 90 to suspense account 90 because we have not passed any entry with reference to profit and loss adjustment account because it is related to customer's account, that is personal account of the customer. So entry is customer account debit 90 to suspense account 90 being credit sale of rupees 760 wrongly posted as rupees 670 to the customer's account, now rectified. We are coming to our last. Closing stock was overstated by rupees 9,000 being casting error in the schedule of inventory. So the idea is closing stock overstated means your gross profit was more, your net profit was more, and closing stock is an adjustment entry, and we pass the entry like closing stock account debit to trading account. It will come in the credit side of your trading account and also in the balance sheet. So overstated means closing stock overstated means you have overstated your profit. Hence, you have to decrease the profit, but accounts are already been prepared. Profit has been ascertained. That's why we are passing the entry profit and loss adjustment account debit 9,000 to opening stock account because last year closing stock will be this year opening stock. Then we are going to prepare the suspense account and the relationship in the journal we are going to post into the suspense account, that is 2 profit and loss 150, 2 profit and loss adjustment 1500, then by customers account 90, and this was the balance that was there, that is 1560. Then profit and loss adjustment account also we prepare, that is 2 opening stock 9000, buy suspense account 150, buy suspense 1500, buy office furniture account 6000, and buy net profit transfer, that is 1350. So effect of correction on 2600 profit will be reduced by 1350 subject to depreciation on furniture of rupees 6000. Okay, hope you have understood. Now I am discussing certain guiding principles of rectification of errors. If error is committed in books of original entity, then assume all postings are done accordingly. If error is at the posting stage, then assume that recording in the subsidiary books have been correctly done. Then if error is in posting to a wrong account without mentioning site and amount of posting, then assume that posting has been done on the right side and with the right amount. If posting is done to a correct account but with wrong amount without mentioning site of posting, then assume that posting has been done on the correct side. If error is posting to a wrong account on the wrong side without mentioning amount of posting, then assume that posting has been done with the amount as per the original recording of the transactions. If error is of posting to a wrong account with wrong amount without mentioning the side of posting, then assume that posting has been done on the right side. If posting is done to a correct account on the wrong side without mentioning amount of posting, then assume that posting has been done with correct amount as per original recording. Any error in posting of individual transactions in subsidiaries books relates to individual account only. The sales account, purchase account, sales return account or purchase return account are not involved. If a transaction is recorded in cash book, then the error in posting relates to the other affected account, not to cash account or bank account. If a transaction is recorded through journal proper, what is journal proper I have already mentioned today, then the purchase transaction was not posted, indicates error in both the accounts involved unless stated otherwise. Error in casting, adding of subsidiary books will affect only that account where total of the particular book is posted, leaving the individual personal accounts unaffected. So these are the rules. Now we are coming to solve this problem. Rectify the errors. I am just considering this so that you can easily understand how the rectification entries are actually being done. Now you see, rectify the following errors. Credit purchases from Raghu rupees 20,000 were not recorded, were recorded as rupees 10,000, were recorded as rupees 25,000, were not posted to his account, were posted to his account as rupees 2,000, were posted in Raghav's account, were posted in the debit of Raghu's account, were posted to the debit of Raghav account, were recorded through sales book. So credit purchases from Raghu rupees 20,000. These are the items, that is 1 to 9. The errors which are committed, how you are going to rectify, taking into account 1, 2, 3, 4, all are independent items. Then credit purchases from Raghu rupees 20,000 were not recorded. That means complete omission of the entry. That is, purchase account will be debited by 20,000 and to Raghu's account 20,000. Credit purchases from Raghu omitted to be recorded, now corrected. Second one, credit purchases from Raghu rupees 20,000 were recorded as rupees 10,000. So purchase account will be debited by difference amount, that is 10,000, to Raghu's account also 10,000. That is credit purchases from Raghu recorded as rupees 10,000 instead of 20,000, now corrected. Third one were recorded as rupees 25,000. So suspense account will purchase account, that is number 3 are talking, were recorded as rupees 25,000. Number 3, that is purchase account debit to Raghu 10,000, 10,000. Then suspense account debit to Raghu 20,000, 20,000. So in this way we are going to record, that is just look into the correction entries and the narration. Purchase account debit 10,000 to Raghu's account 10,000. Credit purchases from Raghu recorded as rupees 10,000 instead of rupees 20,000, now corrected. Then suspense account debit to Raghu's account 20,000, 20,000. Credit purchases from Raghu were not posted in his account, now corrected. Then credit purchases from Raghu rupees 20,000 posted to his account as rupees 2,000. Then suspense account debit, and it is the error relating to Raghu account. So the entry will be suspense account debit 18,000 to Raghu's account 18,000. That is credit purchases from Raghu rupees 20,000 posted to his account as rupees 2,000. Then credit purchases from Raghu wrongly credited to Raghav account. So Raghav account is to be cancelled by debiting it by 20,000. To Raghu's account it will be 20,000. That is credit purchases from Raghu wrongly credited to Raghav, now corrected. Next, credit purchase from Raghu rupees 20,000 wrongly posted to the debit of his account. So we have to cancel Raghu. So we have to credit Raghu, and it is an one-sided error and amount will be double. So that's why suspense account will be debited by 40,000 to Raghu's account 40,000. And the narration is credit purchases from Raghu rupees 20,000 wrongly posted to the debit of his account, now corrected. Next, credit purchases from Raghu rupees 20,000 wrongly debited to Raghav, now corrected. So Raghav account is to be cancelled. That's why you have credited Raghav. Raghu's account is not credited. Hence we have to write to Raghu account. An amount will be come to 20 plus 20, that is 40,000 in suspense account. That is credit purchases from Raghu rupees 20,000 wrongly debited to Raghav, now corrected. Next, credit purchases from Raghu wrongly recorded through sales book. So purchase is recorded as sales. Hence sales account is credited. Hence we have to cancel the sales. That's why you have to debit sales 20,000. Purchase account is not recorded. You have to debit purchase account by 20,000, and Raghu account will be credited by 40,000. That is credit purchases from Raghu wrongly recorded through sales book, now corrected. Okay. So in this way we are going to adjust. Now we are coming to next sum. Trial balance of Anurag did not agree. It showed an excess credit rupees 10,000. Anurag put the difference to suspense account. He located the following errors. Sales return book overcast by rupees 1,000. Remember, sales account having credit balance, but sales return account always having a debit balance. Purchases book was undercast by rupees 6,000. Purchase always having a debit balance and purchase return having a credit balance. In the sales book total of page number 4, was carried to page 5 as rupees 1000 instead of 1200, and total of page 8 was carried forward to page 9 as rupees 5600 instead of rupees 5000. Goods returned to Ram rupees 1000 were recorded through sales book. Credit purchases from him and company rupees 8000 were recorded through sales book. Credit purchases from Ace and company rupees 5000 were recorded through sales book. However, Ace and company were correctly credited. Salary paid rupees 2000 was debited to employees' personal account. Okay, so we are going to rectify the errors. How? Suspense account debit to sales return, that is sales return book overcast by rupees 1000, now corrected. Purchase account debit 600 to suspense account 600. Purchases book undercast by rupees 600, now corrected. Then sales account debit 400 to suspense account 400. Error in carry forward of sales book, now corrected. Now, errors in carry forward the total of one page to another during a period finally affects the total of that book, resulting in error of under/overcasting. In this case, carry forward from page 4 to 5 resulted in undercasting of rupees 200, and carry forward from page 8 to 9 resulted in overcasting of rupees 600. Then overall overcasting being 600 minus 200, that is 400. Okay, and accordingly we have to adjust. Okay, so sales account debit 400 to suspense 400. Then sales account debit 1000 to return outwards account 1000. Return out was wrongly recorded through sales book, now rectified. Then credit purchase is wrongly recorded to sales book, that is purchase account will be debited, sales account will be debited to M and company's account 16,000. That is credit purchase is wrongly recorded to sales book, now rectified. Then credit purchase is wrongly recorded to sales book, however suppliers account correctly credited, now rectified, that is purchase account debit, sales account debit to suspense account 10,000. Then salary to employees personal account. Remember, when salary is paid to an employee, then salary account is debited and cash or bank account is credited. So instead of that, you have debited employee's personal account. Hence, you have to cancel the mistake, and salary is a nominal account will be debited. So salary account debit 2000 to employee's personal account 2000. That is salary paid wrongly debited to employee's personal account, now corrected. Now we may go for the preparation of suspense account. That is, we are writing buy purchases, buy sales, buy purchases, buy sales. All the entries which are related to suspense are actually being taken into suspense account, and sales returned 1000. And remember, these rupees 10,000 was the difference as per trial balance. Now it is adjusted. Now, another question, trial balance of Rahul did not agree. Rahul put the difference to suspense account. Subsequently, he located the following errors. So just have a look, allow me 2 minutes. Okay, just have a good look and please allow me 2 minutes, and we'll be taking care of this problem also. Please read the problem, okay, and allow me just 2 minutes. Now, look into the problem. Trial balance of Rahul did not agree. Rahul put the reference to suspense account. Subsequently, he located the following errors. Wages paid for installation of machinery rupees 600 was posted to wages account. So purely it is an error of principle. So any wages paid for the installation of machinery, that should be added with the cost of the machinery. Hence, machinery account will be debited and wages paid wrongly debited should be credited. Repairs to machinery for rupees 400 debited to machinery account. So far the amount is concerned, rupees 400, it is small, very small amount. Hence, it is not going to increase the life of the machinery. Hence, it is a normal repairs. So machinery account will be credited and repairs to machinery will be debited. Repairs paid for the overhauling of second-hand machinery purchased rupees 1000 was debited to repairs account. Remember, this is overhauling of second-hand machinery to put it into the current running condition. Hence, machinery account will be debited and repairs will be credited. Own business materials rupees 8000 and wages rupees 2000 were used for construction of building. No adjustment was made in the books. So we have to bring this in our books of accounts. Furniture purchase rupees 5000 was posted to purchase account. So furniture account will be debited and purchase account will be credited. Old machinery sold to Karim at its book value rupees 2000 was recorded to sales book. So sales account will be debited and old machinery account will be credited. Total of sales return books rupees 3000 was not posted to the ledger. So sales return always have a debit balance. So sales return account will be debited and suspense account will be credited. Rectify the above errors and prepare suspense account to ascertain the original difference in trial balance. So let us see the journal entries. Machinery account debit to wages account 600. Wages paid for installation of machinery wrongly debited to wages account, now rectified. Then repairs account 400 is a small repairs was debited to machinery account. Hence, repairs account will be debited by 400 to machinery account 400. Repairs paid wrongly debited to machinery account, now rectified. So remember, it is a minor repair and it is not going to increase the life of the machinery. Then machinery account debit to repairs account 1000. Repairs for overhauling the second-hand machinery purchase. So you are going to rectify the problems in the second-hand machinery and you are going to make some repair expenses for improving the working condition of the machinery and also to an extent is efficiency. Hence, machinery account will be debited by 1000 and repairs account will be credited by 1000. Narration, repairs for overhauling of second-hand machinery purchased wrongly debited to repairs account, now rectified. Then buildings, that is materials and wages used for construction of building not debited to building account. So wages is 2000 and purchases of materials is 8000. So building account will be debited by 10,000. You have wrongly debited purchases should be credited by 8,000. You have wrongly debited wages should be credited by 2,000. And the narration will be material and wages used for construction of building not debited to building account, now corrected. Then furniture purchased for 5,000 wrongly debited to the purchase account as rupees 500. So furniture account is a real account, debit what comes in should be debited by 5,000. Purchase account you have wrongly debited should be cancelled 500 and balance will come to the suspense account as rupees 4,500. That is furniture purchased for rupees 5,000 wrongly debited to purchase account as rupees 500, now rectified. Then you have sold the machinery and it is credited in the sales account. So that's why sales account is to be cancelled. So sales account will be debited by 2000 to machinery account 2000. That is sale of machinery wrongly recorded in sales book, now rectified. Then sales return books. Remember, sales having a credit balance, sales return having a debit balance, and sales returns book not posted to ledger, that is sales return account, it is not recorded. So that's why sales return account will be debited by 3000 and suspense account will be credited by 3000. Total of sales return book not posted to the ledger, now rectified. Now we are going to prepare the suspense account, and in suspense account we put the double entry, that is furniture 4500, sales return 3000, and there was a difference in trial balance, that is the balancing figure, that is difference as per trial balance 7500. Hence original difference in trial balance was rupees 7500 excess credited. Okay, now another question we are coming. Trial balance of Anantaram did not agree. It allowed an excess credit of rupees 16,000. Mind this, he put the difference to suspense account. Subsequently, the following errors are located. Cash received from Mohit rupees 4,000 was posted to Mahesh as rupees 1,000. So entry will be Mahesh account debit 1,000, suspense account debit 3,000 to Mohit's account 4,000. Narration cash received from Mohit rupees 4,000 wrongly posted to Mahesh as rupees 1,000, now rectified. Then check for rupees 5,800 received from Arnab in full settlement of his account of rupees 6,000 was dishonored. No entry was passed in the books on dishonor of the check. So the entry will be Arnab's account debit 6,000 to bank account 5,800 to discount allowed 200. Check received from Arnab for rupees 5,800 in full settlement of his account rupees 5,000 dishonored, but no entry made in books, now rectified. Now come to next. Rupees 800 received from Khanna, whose account has previously been written off as bad, was credited to his account. So we pass the entry Khanna's account debit 800 to bad debts recovered account. Bad debts recovered wrongly credited to Khanna's account, now rectified. Next, number 4, credit sales to Manav for rupees 5,000 was recorded to the purchases book as rupees 2,000. So the correct entry will be Manav's account debit 7,000 to purchase account 2,000 to sales account 5,000. Credit sales to Manav for rupees 5,000 wrongly recorded through purchases book as rupees 2,000, now rectified. Come to number 5. Purchases book undercast by rupees 1,000. Remember, it is an one-sided error. Purchase having a debit balance. So you have undercasted the purchase book by 1,000. Hence, the entry will be related to suspense account. So purchase account will be debited by 1,000 to suspense account 1,000. That is purchase book undercast by rupees 1,000. Come to number 6. Repairs on machinery rupees 1,600 wrongly debited to machinery account as rupees 1,000. So 1,600 is the repair, but debited to the machinery account as 1,000. So remaining 600 you have to enter, and it has a relationship with suspense also. That is repairs account debit 1,600 to machinery 1,000 to suspense account 600. That is repairs on machinery rupees 1,600 wrongly debited to machinery account rupees 1,000, now rectified. Come to number next. That is goods returned by Nathu rupees 3,000 were taken into stock. No entry was recorded in the books. So we are going to rectify the error, that is sales return account debit 3,000 to Nathu's account 3,000, sales return from Nathu not recorded. So after posting the double entry to the suspense account as purchases 1,000, repairs 600, then Mohit 3,000, and you see there was a difference. It is actually being given at the beginning of the question, that is 16,000, it shows excess credit. So this 16,000 is nothing but is the difference that we are going to record. Difference as per trial balance 16,000, then 16,000 plus 3,000, that is 19,000. So balance carried down will be 17,400. So even after rectification of errors, suspense account is showing a debit balance of rupees 17,400. This is due to non-detection of errors or affecting trial balance. Balance of suspense account will be carried forward to the next year and will be eliminated as and when all the remaining errors affecting trial balance are located. Now, I have made a heading summary with reference to learning objectives. So, what we have learned, meaning of trial balance, a statement showing the abstract of the balance debit credit of various accounts in the ledger, objectives of trial balance, to ascertain the arithmetical accuracy of the ledger accounts, to help in locating errors, to help in the preparation of the final accounts. Preparation of trial balance, it can be done in various ways. Then various types of errors. Errors of omission, that is errors caused due to wrong recording of a transaction, wrong totaling, wrong casting, wrong balancing, etc. Then errors of omission, errors caused due to omission of recording a transactions entirely or partly in the books of accounts. Then errors of principle, errors arising due to wrong classification of receipts and payments between revenue and capital receipts and revenue and capital expenditure, that we have already discussed in the last class. Then compensating errors, two or more errors committed in such a way that they nullify the effect of each other on the debits and credits. Then rectification of errors, errors affecting only one account can be rectified by giving an explanatory note or by passing a journal entry. Errors which affect two or more accounts are rectified by passing a journal entry. Then meaning and utility of suspense account, an account in which the difference in the trial balance is put till such time that errors are located and rectified. It facilitates the preparation of financial statements even when the trial balance does not tally. And lastly, disposal of suspense account, that is when all the errors are located and rectified, the suspense account stands disposed of. So that is all about your trial balance and rectification of errors. Hope you have understood. Now we are coming to most important chapter, that is depreciation, provisions and reserves. First we discuss what is the meaning of depreciation. Depreciation may be described as a permanent, continuing and gradual shrinkage, means decrease in the value of fixed assets. It is based on the cost of assets consumed in a business and not on its market value. So depreciation is actually being calculated on the cost of the assets, but not on the market value of the assets. Now, Features of depreciation we are discussing. Number one, it is decline in the book value of fixed assets. It includes loss of value due to change of time, usage or obsolescence. For example, a business firm buys a machine for rupees 1 lakh on April 1st, and in the year, a new version of the machine arrives in the market. As a result, the machine bought by the business firm becomes outdated. The resultant decline in the value of old machine is caused by obsolescence. Number three, it is a continuing process. It is an expert cost and hence must be deducted before calculating taxable profits. For example, if profit before depreciation and tax is 50,000 and depreciation is rupees 10,000, then profit before tax will be 50,000 minus depreciation, that is profit before tax 40,000. It is a non-cash expense because when depreciation is charged, we pass the entry depreciation account debit to asset and profit and loss account debit to depreciation. So no cash is involved. We are not passing the entry depreciation account debit to cash or bank. So it is a non-cash expense. It does not involve any cash outflow. It is a process of writing off the capital expenditure already incurred. Now, the depreciation amount to be charged for during an accounting year depends on depreciable amount and the method of allocation. So basically, in the foundation level, you are having two methods of depreciation. One is called straight line method of depreciation or original cost method of depreciation, and another one is written down value or diminishing balance method of charging depreciation. So the most important issue is the depreciation amount to be charged for during an accounting year depends upon on depreciable amount and the method of allocation. For these two methods are mandated by law and enforced by professional accounting practice in India. These methods are straight line method and written down value method. But other than this, there are other methods also which are not included in your foundation level. Just for academic interest, I have written annuity method, depreciation fund method, insurance policy method, sum of years digit method, double declining method, etc., which may be used for determining the amount of depreciation. Now, we will be concentrating on two methods. One is straight line method, another one is written down value method. The selection of an appropriate method depends upon certain consideration. Number one, type of the asset, nature of the use of such asset, and the circumstances prevailing in the business. Now let us discuss straight line method. This is the earliest and one of the most widely used methods for providing depreciation. This method is based on the assumption of equal usage. Usage means use of the asset over its entire useful life. It is also called fixed installment method because the amount of depreciation remains constant from year to year over the useful life of the asset. According to this method, a fixed and an equal amount is charged as depreciation in every accounting period during the lifetime of an asset. So depreciation amount being the same, the amount annually charged as depreciation is such that it reduces the original cost of the asset to its scrap value. Scrap value means realizable value, the value that we are going to get at the end of the life by selling the assets, we get certain amount that is called scrap value. And definitely at the end of its useful life. This method is also known as fixed percentage on original cost method because same percentage of the original cost, in fact depreciable cost, is written off as depreciation from year to year. The depreciation amount to be provided under this method is computed by using a formula, and the formula is depreciation is equal to cost of asset minus estimated net residential value, that is estimated useful life of the asset. Now, rate of depreciation under straight line method is the percentage of the total cost of the asset to be charged as depreciation during the useful lifetime of the asset. And the rate of depreciation is calculated as rate of depreciation is equal to annual depreciation amount divided by acquisition cost of the asset multiplied by 100. Now, the next item is written down value method. Under this method, depreciation is charged on the book value of the asset. Okay, since book value keeps on reducing by the annual charge of depreciation, it is also known as reducing balance method. This method involves the application of predetermined proportion of the percentage of the book value of the asset at the beginning of every accounting period so as to calculate the amount of depreciation. The amount of depreciation reduces year after year. For example, the original cost of the asset is rupees 2 lakhs and depreciation is charged at the rate 10% per annum at reducing balance method, another name written down value. Then the amount of depreciation will be computed as depreciation first year 20 lakhs divided into 100 into 10 by 100, it comes to 20,000. So written down value at the end of the year, that is 2 lakhs minus 20,000, that is 1,08,000. Depreciation second year, rupees 1,80,000 into 10%, that is 18,000. So written down value rupees 1,80,000 minus 18,000, that is 1,62,000 at the end of the second year. Depreciation third year, 1,62,000 into 10 by 100, it comes to 16,200. So written down value is equal to 1,62,000 minus 16,200, that is 1,45,800 at the end of third year. So there are two basic methods which are actually being used for charging the depreciation on assets. And these are, I have already told you, that is straight line method and diminishing balance method. Now, next question that is coming in our mind, what are the various methods of recording depreciation in the books of account? Okay, we have to record the depreciation in the books of accounts, and what are the various methods that we are going to discuss. Now, in the books of account, there are two types of arrangements for recording depreciation on fixed assets. The first one is charging depreciation to asset account or creating provision for depreciation or accumulated depreciation. So in the books of account, I repeat, there are two types of arrangements for recording depreciation on fixed assets, one is charging depreciation to asset account or creating provision for depreciation or accumulated depreciation account. Accumulated depreciation means summation of depreciation up to the nth year. Now, if we refer to charging depreciation to asset account, then how these are actually being taken care of, that we are discussing. According to this arrangement, depreciation is deducted from the depreciable cost of the asset. Of course, so credited to the asset account and charged or debited to profit and loss account. So journal entries under this recording method are at the year of purchase, including cost of the assets and installation, freight, etc. For all that, for recording purchase of asset, we pass the entry asset account debit to bank or vendor, that is supplier account. Following two entries are recorded at the end of every year for deducting depreciation amount from the cost of the asset. So journal entry will be depreciation account debit with the amount of depreciation to asset account. So depreciation is the nominal account, means loss. Your asset value is decreased, asset having a debit balance. And if you want to decrease the asset, then you have to credit it. So asset account will be credited. And in order to prepare the PL account, we are going to transfer the amount of depreciation to the profit and loss account. That is, for charging depreciation to the profit and loss account, the entry will be profit and loss account debit to depreciation with the amount of depreciation. Number 3, balance sheet treatment. When this method is used, the fixed asset appears at its net book value, that is cost less depreciation charge till date, on the asset side of the balance sheet, and not at its original cost, also known as historical cost. So original cost minus the depreciation total amount up to the date is deducted and shown in the asset side of the balance sheet. Next method, creating provision for depreciation account or accumulated depreciation account. Accumulated depreciation account means, say we are recording for the 5th year, then first year depreciation plus second year depreciation plus third year depreciation plus 4th year depreciation plus 5th year depreciation. All depreciation we add, it becomes accumulated depreciation. So this method, that is creating provision for depreciation account or accumulated depreciation account, this method is designed to accumulate the depreciation provided on an asset in a separate account, generally called depreciation provision or accumulated depreciation. Such accumulation of depreciation enables that the asset account need not be disturbed in any way, and it continues to be shown at its original cost over the successive years of its useful life. So mind this, such accumulation of depreciation enables that the asset account need not be disturbed in any way, and it continues to be shown at its original cost over the successive year of its useful life. There are some basic characteristics of this method of recording depreciation, which are as under. Just have a good look. Asset account continues to appear at its original cost year after year over its entire life. Depreciation is accumulated on a separate account instead of being adjusted into the asset account at the end of each accounting period. And for purchase, in the year of purchase, we pass the entries, that is cost plus installation expenses, etc. for purchasing, for purchase and recording of purchase of assets. We pass the entry asset account debit to bank oblique vendor account. As usual, as usual, as usual, that is asset account debit to bank oblique vendor account only in year of purchase with the cost of asset including installation expenses, etc. to bank oblique vendor account, that is cash oblique credit purchase. Following two journal entries are recorded at the end of each year. For crediting depreciation amount to provision for depreciation account, the entry will be depreciation account debit to provision for depreciation account. And for charging depreciation to profit and loss account, PL account debit to depreciation with the amount of depreciation. Number 3, balance sheet treatment. In the balance sheet, the fixed asset continues to appear at its original cost on the asset side. The depreciation charge till that date appears in the provision for depreciation account, which is shown either on the liability side of the balance sheet. Provision for depreciation, remember, it is shown in the liability side of the balance sheet or by way of deduction from the original cost of the asset concerned on the asset side of the balance sheet. Okay, so common entry is asset account debit to bank oblique vendor and PL account debit to depreciation. Only change is depreciation account debit to provision for depreciation account. Now we are coming to solve one problem. Singanta and brothers purchased a plant for rupees 5 lakhs on April 1, 2002 and spent rupees 50,000 for its installation. The salvage value means scrap value of the plant after its useful life of 10 years is estimated to be 10,000. Record journal entries for the year 2002-03 and draw a plant and depreciation account for first 3 years given that the depreciation is charged using straight line method if the books of account close on March 31st every year, and number 2, the firm charges depreciation to the asset account. Now we are preparing the journal entries first. Plant account debit to bank 5 lakh, purchased a plant for rupees 5 lakhs. Then plant account debit to bank account, expenses incurred on installation 50/50. So total plant account is debited by 5 lakh 50. Then depreciation to plant 54,000. Then profit and loss account debit to depreciation, that is 54,000. Now journal to ledger, to bank 5 lakh, then to bank installation expenses 50,000, by depreciation 54,000, by balance CD 4,96,000. Then that balance is brought forwarded 4,96,000. Depreciation is 54,000. Straight line method. Balance carried down is 4,42,000. Then that balance is brought forwarded 4,42,000. Again by depreciation 54,000. Balance carried down is 3,88,000. And finally the balance of the plant after 3 years it becomes 3,88,000. Now in depreciation account we are writing to plant 54,000, by profit and loss account 54,000. Again in the second year, to plant 54,000, By profit and loss account 54,000, same type of entry, that is two plant 54,000, profit and loss account 54,000. Now the question comes, how we got these rupees 50,000, 54,000 that I have used as depreciation, where from the amount has come. So look into the problem. 5,000 is the cost of the plant. 50,000 is the installation charges. It comes to 5,50,000. Then 10,000 is the scrap value, salvage value. Then 5,50,000 minus 10,000, 5,40,000 is the amount on which depreciation is to be charged, and that divided by 10 years, it comes to 54,000. So that is the calculation I have shown. Just have a look. Purchase of plant 5 lakhs, then installation cost 50,000. So total cost, original cost after installation, it comes to 5,50,000. Then salvage value we are deducting 10,000. Useful life 10 years. So depreciation amount 5,50,000 minus rupees 10,000 divided by 10, it comes to rupees 54,000 per annum. Now we are coming to the next problem. Mrs. Behra and Sons acquired a machine for rupees 1,80,000 on 1st October and spent rupees 20,000 for its installation. The firm writes off depreciation at the rate of 10% on original cost of every year. Record journal entries for the year and draw up machine account and depreciation account for first 3 years, given that the books of account closes on March 31st every year. The firm charges depreciation to asset account. So obviously, we are going to pass in the books of Behra and Sons journal, that is machine account debit to bank 1,80,000, 1,80,000. Then machine account debit to bank, that is 20,000, 20,000, expenses incurred on installation. Then we are going to charge depreciation. Depreciation account debit to machine 10,000. Then profit and loss account debit to depreciation. Next year, depreciation account debit to machine 20,000. And profit and loss account debit to depreciation 20,000. Next year, depreciation account debit to machine 20,000 and PL account debit to depreciation, that is 20,000. I'll come. Then in machine account we are writing bank 1,80,000, bank 20,000, total is 2 lakhs. Remember, on 1st October it was purchased. Then up to March 31st, depreciation will be for 6 months, that is 10,000. And that 10,000 we have written over here, depreciation account debit to machine 10,000, 10,000. And the same amount is actually being transferred to PL account as 10,000, 10,000. Now for other years, the depreciation amount is 20,000. How? Just have a look. So at the end of the first year, we are having balance CD 1,90,000. That balance is brought forward at 1,90,000 and depreciation will be, amount will be 20,000 because 10% on original cost. So your original cost of the plant was 2 lakhs. Hence, every year from the next year onwards, depreciation will be 20,000, that is 10% on 2 lakhs. And that's why second year and third year depreciation is 20,000. So first year depreciation is 10,000, that is for 6 months. And for other 2 years, depreciation is charged for full year, that is on 2 lakhs at the rate 10%, that is 20,000, 20,000. So calculation of original cost of the machine, purchase cost 1,80,000, add installation cost 20,000, original cost 2 lakhs. Depreciation 10% of 2 lakhs every year, that is 20,000. During the year 2003, depreciation shall be charged only for 6 months, as acquisition date is October 1st, that is asset is used only for 6 months during the year. Depreciation for the first year, 20,000 into 6 by 12, that is 10,000. So in the books of Mehra and Sons, machine account will appear as 2 bank 1,80,000, then 2 bank installation expenses 20,000, buy balance carried down 2 lakhs, then 2 lakhs, then if we maintain provision for depreciation account, then it will be buy depreciation, 2 balance carried down, buy balance BD 10,000, depreciation 20,000, so 2 balance carried down 30,000. Then again buy balance BD 30,000, depreciation for the year 20,000, so 2 balance carried down 50,000. So in depreciation account, we'll be having provision for depreciation 10,000, buy PL 10,000, then 2 provision for depreciation 20,000, buy profit and loss 20,000, then provision for depreciation 20,000, buy profit and loss 20,000, like that. Now we are coming to disposal of the asset. So if asset is sold or disposed of, then how these are recorded, that I am discussing. So we'll discuss up to this, and after that we'll close our session today. Disposal of asset can take place either number A, at the end of its useful life, or number B, during its useful life due to obsolescence or any other abnormal factor. If it is sold at the end of its useful life, the amount realized on account of the sale of asset as scrap should be credited to the asset account, and the balance is transferred to the profit and loss account. In this regard, the following journal entries are recorded. Number 1, for sale of asset as scrap, the journal entry is bank account debit to asset account. For transfer of balance in asset account, in case of profit, asset to profit and loss account, and in case of loss, profit and loss account debit to asset account. Now, in case, however, the provision for depreciation account has been in use for recording depreciation, then before passing the above entries, transfer the balance of the provision for depreciation account to the asset account by recording the following journal entry. Provision for depreciation account will be debited and asset account will be credited. Now, for example, RS Limited purchased a vehicle for rupees 4 lakhs. After 4 years, its salvage value is estimated at rupees 40,000. Salvage value means scrap value. To find out the amount of depreciation to be charged every year based on straight line basis and show as to how the vehicle account would appear for 4 years, assuming it is sold for rupees 50,000 at the end when depreciation is charged to asset account, and number B, provision for depreciation account is maintained. So we'll be discussing the first part, and in the next class we'll be discussing the second part. And remember, after completing all the chapters, we'll be going through MCQ questions and answers. Okay, so after finishing joint venture consignment, bills, non-profit seeking, funnel accounts, then cost accounting, cost sheet, etc. We'll be covering the MCQ. So please be there, and when we'll be discussing all these, then definitely it is going to help you in the examination hall. Now, when depreciation is charged to asset account, then we write vehicle account debit to bank. So to bank 4 lakh, depreciation is 90,000 and balance carried down is 3 lakh 10. Then the balance is actually being brought forwarded as 3 lakh 10 at the end of the year. By depreciation 90,000, by balance carried down 2 lakh 20. Then in the third year, closing balance will be brought forwarded as opening balance, depreciation is to be charged and closing balance is to be carried down. Then again, in the fourth year, two balance brought down, 1 lakh 30, depreciation 99, and bank account 50,000. So profit and loss account, profit on sale of vehicle 10,000, that is transferred. Now when provision for depreciation account is maintained, then we write to bank 4 lakh, end of the year by balance carried down 4 lakh. That is vehicle account. You see, all are maintained at the original cost. Second year also 4 lakhs. Then third year also 4 lakhs. But in the fourth year, we are having 4 lakhs. Then by provision for depreciation, 3 lakh 60 and bank account 50 to profit and loss account, that is profit on sale of vehicle is 10,000. So in provision for depreciation account, we write by depreciation 90,000 first year, to balance BD by depreciation, then by balance carried down, by depreciation for the year, to balance BD, then to balance BD 2 lakh 70, by balance carried down, then by depreciation 90,000, then 3 lakh 60,000, that is by balance carried down 2 lakh 70, by provision for depreciation 90,000. So these are the entries which are actually being taken place. So for the depreciation, providing for depreciation is concerned. So we'll be using use of asset disposal account. We'll be discussing it in the next class. Hope you have understood what I have discussed today. Okay. Please tell your all friends to participate so that when I'll be discussing all these things that are actually needed for examination point of view, and our time is limited, and with this time I try to cover most of the items. And thank you for listening to me. Thank you for patience for attending this particular time. So hope you have understood what I have discussed, and I am closing today. Thank you very much and see you in the next class with the remaining portions, and hope you'll be in a position to understand what I'll be discussing. With that, I close today. Thank you very much.
Thank you, sir.